Right. Hello, I'm interviewing the CEO and Executive Chairman of Voxtur, Gary Yeoman. And without further ado, the first question. So you made some basically predictions on the first quarter. And I wanted, in the last interview you did with Marius, and I wanted to kind of specify them. So do you mean you think you're going to be EBITDA positive or adjusted EBITDA positive? And do you think you're going to be cash flow positive without the impact of, like receivables and payables, making it look better, So that would be my first question.
Okay, well, again, thanks for having me, Eunice. Appreciate it. As everyone knows, the influence of Blue Water, given the size of the transaction, and it was, has a tremendous impact on Voxtur, and its future. And it's no secret that, with the advent of the MSR business falling off 80% and the whole impact of interest rates and changes in that clearly had a tremendous impact on Blue Water. And it also significantly, affected the revenue and the profitability. What we've found, over the last year is that Al Qureshi has been steadfast in basically introducing, new platforms, pre-close, post-close, due diligence, insurance, providing loans on non-QM and whole, or valuations and trades on non-QM and whole loans. And because of that, we've seen, an advent of increased business activity starting in the first quarter. We've just completed a fairly large trade on a bulk deal, and that's very, very healthy for us. We have a number of other bulk deals that are in the, under the hood, so to speak. And we fully are hopeful that they close, by the end of March. So if they do, we'll be EBITDA positive, not adjusted EBITDA, and cash flow positive. If they straggle into the few days into April and that, there may be a slight adjustment, but the influence that Blue Water has on us is, has been significant. We had to, invest a lot of money to acquire that franchise. I will tell you that we love the business. We love what Al Qureshi is doing. We love the fact that he's been unrelenting with respect to his growth and his diligence to get this business going. And we do believe that that business in 2024 is going to exceed the pre-valuation of that business, or the pre-performance of that business that in the year that we purchased it. So 2022, I guess, was that year. So if Al closes on all of the deals, we'll be significantly cash flow positive and EBITDA positive. And depending on how much he closes, we could, break even. It really gets down to timing on everything. The long-term prognosis is there's an abundance of deals in that platform. All the other businesses are doing well and they're meeting expectations. But we have a lot, riding because of our costs on that, on Blue Water. And Blue Water is also significantly influential in providing due diligence opportunities for our valuation group, for our tax and flood certificates, and for our title group. And so it not only provides revenue opportunities to augment and boost Voxtur's overall financial prognosis, but certainly will impact all the other businesses as well. So we're hopeful that the Q1 is cash flow positive and EBITDA positive. If it's not, it'll be because a few of those deals that we expect to close this quarter, if they linger into the second, then we'll pick up the gain then.
I'm interested about those bulk deals. So let's say you have one bulk deal that's $3 billion. How much is that gonna make for Blue Water?
Again, we're very much, bound by, our NDA, and to kind of forecast that every deal is going to be different. And a lot depends on what is constituted in the deal. Bulk deals could be a pure transaction where we get a fee. It can be on a per loan basis, a dollar value per loan. If there's pre or post close information that is required, then we get a fee for that. If there's due diligence that is required, then we get a fee for that. So every bulk deal is valued differently. But I will say that it is significantly impactful for us on that valuation and on that deal. And so I'm somewhat concerned, because you and I had talked recently that there's a number of very intelligent and very sophisticated sleuths, so to speak, that are able to kind of figure out who we're doing business with. And, that's through architecture that I'm not familiar with, and certainly, can't confirm or deny. And so divulging exactly how much we make on a specific deal, if that could ever lead back to who we did that deal with, would be, a material breach, our NDA. So we have to be careful. So, when we purchased this business, we were on the plane of $18 million of revenue and $11 million of profit. And for 2024, we fully expect to, do much better than that. We have a lot of opportunities presented for us. Again, not just in bulk, but a lot of flow deals that we're doing as well, that we're going to process. We just finished signing 3 new deals for our pre and post close due diligence, and so we're quite excited about that. So every deal is going to be different depending upon the amount of concentration level of the services that we offer, and one deal kind of doesn't fit all. So I know that I'm not as exact as what you'd like me to be, but it's a good business. The business is getting better. We love what we're doing. We love the opportunity of the integration, and we have completed 1 deal already that took place in February, and it was a significant contribution to our revenue for our team, and that's what's made me buoyant because of the other deals that are forthcoming.
Yeah. So what I'm getting is Blue Water is kind of gonna make you profitable, but I'm interested. Like, let's say you didn't have Blue Water, when would the rest without Blue Water be like, let's say, EBITDA positive?
Well, let's put it this way: without Blue Water, we wouldn't have had. We contributed $30 million as a down payment in cash, $30 million US. And also the team that we put together to augment and to support Blue Water in all of its endeavors wouldn't be there as well. So it'd be really, really difficult right now to find out at what point and where we would be if we extracted all of the manpower and the infrastructure that we need to support Blue Water. But each individual business unit that we have within Voxtur is profitable. And that includes obviously Blue Water now. How profitable Blue Water will be is yet to come. And again, I'm happy, and I think that over the course of this interview, you're going to be asking a number of questions about a number of different business units. And I think, with the exhaustion of this interview, you'll have a pretty good overview of what we are doing and the kind of contribution that these businesses are. But we do have a valuation business, not the AMC business, but the valuation business that is profitable. We do have, a data business that is profitable. We do have an assessment business that is profitable. And so and obviously for the first time ever in the 3 years since we got into title, since we took on that opportunity for title when we bought A-Law, for the first time, that business is profitable and growing, and we're very excited about, where title is going, and I'm happy to talk about that during the course of this interview at your convenience.
Yeah, and when you say profitable, I assume you mean profitable without the costs of running a public company,
Correct.
excluding
Correct.
corporate.
Correct.
Okay.
Correct.
So with the profitability, you have put out some goals, I would say. 50% profit margin, 75% gross margin. I wanted to get something from this. So do you expect this to be the average for this year, or that you will reach this at some point in the year? And
so
okay.
to be clear, 50% is a pretty noble benchmark to attain, and I think you acknowledge that and recognize that. And with the comminglement of all the businesses that we had, we certainly haven't met that target. As I said at the outset of my interview with Marius and now with you, we do have debt that we need to remediate. It is our goal over the next 2 quarters to have all of that debt eliminated, or at least only a de minimis amount left of that debt. We are retooling with BMO. They still have great support for us, but just like everything in life, sometimes it's an opportunity is required for you to kind of clean the troughs and start fresh again. And so we have been fairly vocal that it is our intention over the next 2 quarters to be involved with some dispositions on businesses that are not focused on technology, or certainly materially less focused on technology, that have large quantities of people and not high profit margin businesses. As we transition from those, they will do 2 things. Number one, it will eliminate our debt, or at least significantly reduce it. And number 2, by taking away businesses that on our standalone are 10 and 15 or 20% profitability, and transitioning to the technology businesses that are 50% profitability, that's where we're going to go. So 50% is not attainable as profitability now, but it's our goal by the end of the year, with the transition of moving our non-technology pieces, which are non-strategic for us, number one, and number 2, to build out and enhance existing service offerings that we have, commingle with new growth, with new platforms that we have spent significant amounts of money on, that will take place in 2024. And with the advent of that indoctrination of the new platforms and of us focusing on pure technology, that's when we'll see margins of that magnitude.
I'm interested, what businesses that you have now go into that 75% gross, 50% profit?
I think that I'm going to have to, stay reasonably quiet on that, because there may be some businesses that we have that only pieces of them will go, and other businesses, may be larger, and it would be unfair for me to discuss, the outcome of what that may be without us, having full disclosure on exactly what we're going to do. We have lots of interest in all of the businesses in Voxtur. We're very much focused and very committed to long-term the technology arm of Voxtur. And so let's just see how that plays out over the next few months. You'll see in due time that there will be some dispositions, and I'll have a better opportunity. Like I explained before, we didn't tell anyone we were selling the valuation business. But when we did sell it, we basically said, listen, we didn't sell the valuation business, we sold the AMC arm of the valuation business. What we kept was the sketching, the floor plan layouts, the data collection, which is going to replace a lot of the appraisals that are being done today. And so what we see over the next couple of years is a significant decline in appraisals that are required in the way that people know it today. And it will transition into sketches, floor plan layouts, data collection, and that can mingle together with an AVM, whether it's from Fannie or Freddie, will be the new transitioning for valuation. We expect over the next 24 months, it could be as high as 50%. Right now, it's only 3 to 4%. So it's got a long way to go, but it is going to be aggressive as we see over the next 24 months for a multitude of different reasons. Number one, it's not affordable to do a traditional appraisals the way they're done today. Number two, when you talk to the appraisers, they're dropping so many things because they can't afford to pay for anything right now based on what they're getting paid and the cost of doing business. Owning an AMC is extremely expensive today because of licensing and regulatory obligations that you have to comply with. So unless you're very, very big, the chances are for a small AMC to be successful in the way business done today is extremely difficult. So what we are trying to do, to be perfectly candid with you, is to provide a whole bunch of technology services, pure technology services that we can provide to them so that they can still do the work and still get revenue generations, but be exclusive by using our technology to perform it. So it can be done quicker, it can be done more affordable, and the final product will be more accurate. So our goal over the next 24 months is to work very closely with AMCs and be a provider for sketches, for floor plan layouts, for data collection, and any other specific service that they need. So in time, I think over the next 4 months or so, I'll be able to be more explicit on what our business is going to look like, but it's certainly not going to be the same as what it is today.
And about the dispositions, this might also be one that you cannot answer at least accurately, but I'm looking for rough estimates, like rough timelines, rough numbers. So I guess we're thinking about when and how much revenue and EBITDA are we going to lose roughly, and also the amount you're expecting, like roughly, like is it going to be the scale of the last disposition or something smaller?
It's collectively, it's going to be similar. It may not be quite as much, but our debt right now is around 28 million US, in that ballpark. And so we and both the bank and ourselves have agreed that we would like to retool and get that back down to a small amount, and then work forward with the bank as we grow at our technology platforms and continue to retrench, retool, and go forward and building this business. So we have a lot of support by the Bank of Montreal. But one of the things that we have agreed to is that we're going to, right size our debt. So it's not even a question of if, it's definitely when we'll do that. And so over Q2 and Q3, you'll see all of those things take place.
Right. So I would expect if it's similar size to the AMC, I would expect a decent cut in just the revenue, etc. But because if you're gonna sell non-technology revenue,
let's put it this way: we're replacing the revenue and the profits that we got from the AMC with, over the course of 2024, that will be displaced with revenue from sketching, floor plan layouts, data collection tools. And so we fully expect to be as equally profitable, if not more, over the course of time because there was zero revenue attributed to that before. So it was why we bought Apex, is to grow that business with the technology we have with sketches of floor plans. And we already got a pre-approved data collection tool by Fannie. So it's just kind of commingling those and offering them as a technology tool. So what's really, really important to us is what we do right now is not compete with AMCs. AMCs are always going to be around, but some of them are not going to be able to, stick in. So I think you're going to see a large consolidation of AMCs over the course of the next couple of years. But essentially what we want to do is, as part of allowing them to stay around, is we want to sell them technology. Technology, for example, if we have sketches and floor plan layouts and data collection, you can use our technology to be able to create that, but will allow you to use your own appraisal panels, your own inspection panels, will allow you to collect that data and put it together and provide that to the lender. So our intention is to work very closely with AMCs, where before we couldn't, because you can't effectively bite the hand that feeds you. So we're not in that space anymore. And so we feel very comfortable that the strategic plan we have is by providing AMCs with our technology, we're going to be working in partnership with them, which is unique.
One of my questions was that would you refinance the debt? But now that you said that you expect cash flow positive and you expect this position to be of similar scale than the AMC, then with those, I doubt that's necessary. And I guess a lot of us are looking like, what are we going to own? Like, what kind of company are we going to own a year from?
Well, we're going to be a technology company. One of the things, I mean, obviously we're a data company, and we're and you need data to commingle with technology to be able to deliver products. But for example, what we were doing in title, primarily title before was revenue generated from the default business. Well, everyone knows that the default business has basically been reduced by almost 50%. There's been many programs offered by the lending institutions as a mandate by the federal government that they should offer the homeowner any kind of remediation tool they can. For example, instead of entering into a default program, they would allow the homeowner to tack on the extension of the term of the existing loan, so allow them so they didn't have to put them in default. And so there's a number of different programs that have been put into place, but that, along with the increase in home prices, have basically mitigated a tremendous amount of the default business. As a consequence, we focused on a number of other alternatives in title. We're focusing in more on retail and dealing with real estate agents and brokers, and we're taking great advantage of the referrals from that side of the business. We're focusing on the digitization of the total loan officer business, and so we're very excited about that. We've already started phase one of that digitization, and it's called pre-docs, and we're selling them as we speak. The second phase will be in starter kits, where right now the average title agencies are paying $130. We'll be able to offer that to everyone for half the price. And then we're going to continue on with that whole process and finally get us to the point where we fully deliver a fully digitized loan officer package that basically covers everything from soup to nuts, seed to table, as we refer to. And so we're focusing our energy, number one, on the digitization of the title industry, which no one is doing right now. The second is the transition more into new purchases, away from defaults, because we don't see that coming back anytime soon. And obviously, we've introduced a new piece of technology to determine what is the best kind of title people should have. We call that Best X. So we put together a really neat piece of technology that anyone that's looking to get, has bought a home and needs to have title or refinancing, whatever the initiative is to require a new title doc, we're able to provide a tool to them to determine what is the best type of title insurance they should have, AOL or new purchase. What are the reasons that come into consideration? Obviously, price is one thing. Two is the amount and type of insurance coverage that's offered. And everything changes from state to state. What we do know now is that AOL is still very much a fundamental part of our business, and certainly it can only go up because it hasn't been significant to date. But it's caused us to basically retool, and with the augmentation of our technology and our Best X platform, we can now tell any title requirer what is the best platform to use and why, and be able to deliver that to them. And that kind of separates us from pretty much everyone else. So that's why our title business is growing. We are selling some AOLs, although it's not significant right now. But we have, we are implementing our plans, really excited about how title is growing, really excited how Jim Adams and Ryan Marshall are leading the way for our technology, along with some great developers like Lynn and a bunch of other people that are so dedicated to our group. So title is probably one of the, along with Blue Water, with that whole transition, the technology is something that I'm as excited about as anything in 2024.
And I had a question about your default business, which has perplexed me a bit. So you had a 80% drop in your default business from one quarter to another quarter, from Q1 2022 to Q1 2023. It dropped 80%. So can we get some details about this drop?
Yeah, I think that, as I said before, the government initiatives and state mandated default programs, like what they call the Last Chance initiative, many homeowners have been granted extended periods to basically fulfill their obligations. And as a result, mortgage defaults today have been reduced to 1.72% from just, a year ago when they were at 2.5 something percent. And certainly you can find that under any kind of publication like FRED, et cetera, where it's clearly, defined as far as what that fall has been. And as I said before, while many of these developments pose challenges for the default business, we anticipate growth in other segments of our operations. Through Voxtur acquisitions, as I've talked about before, we strategically aligned our title with enterprises focusing on new purchase transactions, lead generations that our data companies able to provide for us, and dealing more directly with lenders and brokers, which we haven't had before. And then obviously the technology, as I said before, default will continue to be a challenge. And so we had to pivot, and that's what we've done. When default is going to come back, I don't know. But as I said before, real estate prices have not fallen off significantly. People still have a lot of equity in their homes. And, while most have taken the advantage of initiatives, like I said, called the Last Chance Initiative, others have decided to sell rather than enter into a default position. So again, our business going forward is going to be new purchase for the most part. We will get some defaults. We're still getting a lot of work from Fannie Freddie, but is not going to come back anytime soon in the way that we thought it was. When we first bought the business, the default business that Albertelli had, A-Law, sorry, A-Law for Albertelli Law, but the business they had was based on default and title, and that's where the money was made for the company. Then COVID came and people were unable to make payments, and there was a moratorium in place, and so default stopped. And we thought, okay, COVID can't last forever. Moratoriums are not going to last forever. It's going to be difficult to reassemble a team, so let's try and suck it up for a little bit. And that was Jim's decision as CEO, was to ride the tide, so to speak, and wait for default to come back. And then we just kind of get to the point where can't wait any longer. We've got to pivot. We've got to transition. We can't, bear any more losses on the title side. And so we made a number of changes, as we previously reported. And now these changes have manifested themselves into profitability and a growing business. We've got over 1,000 referrals right now that are being investigated for title as we speak right now, as a result of the relationships that we've had with our real estate agents and brokers. And before, Albertelli Law and subsequently Voxtur could be profitable at 300 to 400 transactions a month. So we're getting there. We've reduced the staff by 90%, yet we're up to probably close to 200 transactions a month right now. So we're doing it on our own. We're not getting the referrals from the law firm, not that many anymore, but some. But we've pivoted, we've changed the whole title business, changed the strategy, and also introduced the technology and introducing the technology as we go.
I guess kind of past. So what I wanted to get was the drop, the 80% drop in one quarter, and I think it had something to do with the receivable and you changing the business, how you do business with the A-Law. And I guess a lot of people, they saw the drop, over $5 million of revenue drop in one quarter, like that. Is that
yeah,
like,
so essentially we're providing a service to the law firm that essentially we were getting a markup, for our manpower to provide that service. That's how we're getting paid. The markup was profitable, but there just wasn't the work there that they had. So essentially, when it was all said and done, we weren't getting the return. We weren't getting paid, and so we had to make some adjustments.
All right. So that was the drop in Q1 2023.
Yeah. But it wasn't a drop in profitability, I can tell you. Basically, what we did is say we're not going to provide that service. It was a mutual agreement because it just wasn't the work there.
All right. Yeah. So, so I would say that revenue was kind of inflated in 2022.
It wasn't inflated because we certainly invoiced on it. And we billed it. We did get paid. We did have to take a bit of a shave on that receivable, if you recall. But we did collect.
Yeah. Right. So I have some questions about costs. Do you have any goals for like cash operating expenses per month? Like, what are you looking to get to?
Well, we stabilized our expenses. We're not, we basically got, things under control as far as that goes. I mean, let's put it this way. In the 10 months since I've been here, We have dropped our employment from over 525 people down to, I think we're about 175 people right now. We have reduced the debt from 46 million to 28 million. And hopefully over the next 3 months to 4 months, we'll have that debt down to zero. I have cut over $10 million in expenses at the corporate level. We have replaced, we have changed the CEO, the CFO, the COO, the Chief Revenue Officer, the Chief of Staff. Everybody on our team stepped up, including myself, and took on a dual role. Jordan Ross took on a dual role, Chief Investment Officer as well as Chief Operating Officer. Robin Dyson stepped up. She was our former CFO at iLookabout, and she stepped up and took on the role. We've eliminated the role of Chief of Staff. Our Natalia Larson, who was a lawyer on our team, took over the role as Chief Legal Officer. We didn't hire anyone else to replace it. So we've made significant strides and cuts, and that's why we're being profitable. There's no more trying to chase and believe that promises that were made are promises that are going to be kept. So we're lean, exceptionally lean, too lean probably, but sometimes that's what you have to do in order to get back to the point where we're going to be profitable. Concurrently, while we are lean, we're rolling out new piece of technology. Our data group has developed new technology. Our title group has developed new technology. You look at Al Qureshi, I mean, what they have done as far as develop over the last, oh boy, what have they developed over the last year alone? Much more diversified, right? They're now doing, and they have more depth because of it, but they're now doing non-QM loans. They could sell them, they couldn't before. They're now trading on whole loans, they couldn't before. They fully digitized the whole platform, including all of those loans that we've mentioned above. We've added probably 700 to 800 new correspondents that we didn't have before, of which 250 of them are in the Mortgage Collaborative. And so we've just done so much more with respect to augmenting new technology, and that's why our technology costs a bit so high. But that technology is going to replace, the feet on the ground businesses that were being done before that had low profit margins.
Yeah, I had a bunch of questions about cost, so I guess I will. So we had R&D. I guess I would like, because that went up a lot after the Blue Water acquisition. And then non-recurring costs, those have also been higher in the last quarter.
Yeah.
So
there was a lot of money spent on that audit and having to get a new auditor. As everyone knows, our former auditor resigned. We subsequently found out that the reason for resignation, and we can only surmise this because they haven't told us why they resigned, but the reason is they were sanctioned by the SEC and sanctioned by the Canadian Accounting Association, questioning the quality of the audits. That's not for us to opine on. We're not going to. We just know that they were sanctioned. As a consequence, they basically dropped most of their junior clients, especially in Canada. And we were one of them. And they left us high and dry with, basically brought us to the altar. We paid for everything that was required to get that audit completed. We're 2 weeks away. We had to start all over again. So starting all over again is a whole introduction, a whole new set of fees. It cost us millions of dollars. The damage was unrelenting. And of course, some of your investors in that, come to the conclusion they felt that we were in trouble with respect to the quality of our audit and all of the things that were being done. So that was erroneous. It just cost us a lot of money to kind of retool last year.
All right. So we should expect the non-recurring costs to go down.
Lord only knows that, you know, you can't say that you're not supposed to expect anything, but certainly we're hoping for some normalcy over the next months and years to come.
Because this has been a big cost in the adjusted EBITDA, which is,
it sure has.
Why people don't really
yeah, it sure has.
care about adjusted EBITDA because of that item. Then we have so did you reach the goal of 775K per month corporate costs?
Yeah, we even beat that. We even beat
Right,
that.
Good to hear.
Yeah, we even beat that by a considerable amount. So, I mean, honestly, you know, when you reduce that many employees, it was a great expense, and there's also a lot of costs associated with, you know, with removing the employees too, as you can well imagine. So, you know, we've for the most part, we think that we've dealt with 90% of all of those, I'll call them anomalies, and hopefully, you know, 2024 will start, you know, reaping the benefits of all of the challenges and that were brought forth in 2023.
So where did you get to with the corporate costs?
Well, I just finished telling you. I removed.
So I guess you said you beat that 775. So I guess I was asking, like, did you get to 600? Like, where did you get to?
Yeah, we got even less than that. Even less than that.
Right.
Yeah.
But not much less. 500, nothing. Well,
no, I'm not going to be exact because, you know, the thing is I'll be candid with you. Let me say, I think that our whole team has worked around the clock and worked crazy hard, and it's not sustainable. I know, and me doing double duty and putting, you know, 70 and 80 hours a week in is not sustainable. You know, I had a big job before as executive chair, and so what I really wanted to do, and it's not a surprise to any of you, so what I really want to do in 2024 is, you know, get the acquisition or the dispositions completed. I've done all of the trimming, initiate the new technology, and then transition back to being the executive chair and appoint a new CEO. I think it was really important for that new CEO, when they come in board, is to have their ability to be able to look forward and not have to look back. And so I so-called, you know, clean the troughs, did all of the dirty work, did whatever, you know, had to be done, and it was painful to right-size the company, remove a lot of very good people, but people that it just didn't make any sense anymore given the state of the marketplace. So we had to make those changes, you know, and it was extremely difficult. It's not lost to me that when you lose people, those are people that have husbands and wives and children. Those are people that have mortgage payments, and it's painful. It's painful. It's a failing, not entirely in our fault, but some of our fault. I mean, we don't make the marketplace. We don't make the interest rate changes. We don't, you know, create, you know, economic world chaos. But ultimately, it's a very difficult thing. I hope you never have to go through it in your lifetime. When you tell people that we're not able to keep them, it was horrific, and it was painful, and it was something that had to be done. We need to be back to profitability. We need to grow this company. We need to focus on technology, and all of the things that I hoped that we would get done, we got done. 2024 is having Al Qureshi's business in Blue Water come to life, having Jim Adams and Ryan Marshall's business come to life in title, supporting that, having our real property tax analytics business come to life. I mean, that's got to happen. It hasn't happened yet, but it's got to happen. And Jeff Young, he's telling me, every day it's on the truck. It's just not here yet. But the tax business is profitable, but not as profitable as it will be when RPTA has been fully exposed to all 444 municipalities. So we have great upside, with our technology, great upside for our profitability. Obviously, our revenue numbers are going to be down because when you remove businesses, you remove revenue. But in some cases, some of the business that remove are not profitable. So what you're doing is removing some revenue, you're saving some losses, and what you're doing is taking that money and removing the debt, so you don't have mortgage payments anymore. So that's kind of the process we've been through.
Right. So I have some Blue Water questions here. These are all basically now that you have had Blue Water for a while. So basically some like now compared to when you acquired Blue Water, like so market share compared to when you acquired, how many originators you have compared to when you acquired, and revenue breakdown compared to when you acquired.
Yeah, so from a number of correspondents, lenders, banks, etc., we went from 45 to over 700, right? So we have a couple of large subservicers that have many of these, and so you'll come to your own imagination and who they are. I can't disclose, but a lot of banks, a lot of subservicers. So we expect massive growth in our flow business. Some of our clients have been able to reload all the old clients that were lost, and so that's good. And we're back in business. Our flow is getting busier every month, and so our flow has the capabilities of generating as much as $1 million a month, by the end of the year, as if they meet the expectations. So we're really excited about that.
So was that $1 million a month? Were you talking about the one client there?
Pardon me?
So were you talking about the one client there when you said
it's not one client? It's the all of the clients that we're doing flow work for.
Okay, so that's a new thing, the flow work.
Yeah, well, I mean, they had some of that flow work, and then when the interest rates hit, that basically disappeared, and now it's coming back and wild abandoned.
Yeah. So that's one section of the business. Yeah, you can continue. Yep. I just want.
Yep. So you asked, how many correspondents, banks, lenders, etc., have been added, and we certainly have more than, 700 today. So that business has gotten better because of the diversification. I said, Al is now doing, pre and post close diligence, quality control. He's doing, as I said before, he's doing whole loans as well as non-QM. And everything that they do on their platform now has been digitized. Revenue, as I said before, we fully expect 2024 will definitely exceed the revenue and the profitability that we bought the year that we purchased a business. So, I think that's kind of answers to those questions. And I think you said you had a few more with respect to Blue Water that you wanted to answer.
I mean, there was a do you have a market share? I guess that answers
it's really difficult because let's say that there's 30 to 40 billion dollars of bulk deals done every month, right? It'd be really nice, for us to do at least 10%. I mean, that would be, our goal would be to exceed that, but there's no guarantees. But what we do on bulk deals is what a lot of other people are not doing, and that's the fully digitization, the pre and post close, due diligence. I mean, we're able to read all of the documents right now and, digitally, and be able to make sure that all of the documents have been completed properly, and basically eliminate a lot of those requirements from the purchaser, the people that are buying these loans, to be able to send back, and where we have to repurchase them again. So, the diversity of our revenue right now that Al has created has been immense. It's not just the digitization. It's, as I say, there's bulk deals that we do, there's flow deals that we do, and there's the due diligence and the pre and post close. So all of that, and the fact that he's now doing non-QM and whole loans in addition to MSRs is just like, it's a difference between night and day.
And when you acquired it, it was basically just MSRs.
There was some flow as well,
yeah.
but that kind of fell off when the interest rates went up.
Yeah, but let's say like how much were MSRs part of the revenue when you acquired, and how much MSRs are now part of the?
Well, 2024, there's no question that MSR is going to be a big growth for us. And that is because all of the other initiatives that we bring to the table. Our technology is second to none. Everyone wants digitization. No one is doing things manually. They want it quicker, they want it more affordable, but most importantly, they want it accurately. So we're now starting to get more than our market share. Al has spent a lot of time nurturing and building up an investment group, because you can have all of the MSR product out there that you like to have, but the most important thing is you also need to have a willing buyer. And so right now, what we're doing is trying to put the two together. We've identified lots of sellers. We're now trying to build our warship full of very active and aggressive investors.
Is your business still mostly MSRs?
Right now, no. Right now, it's a combination of basic due diligence. Like, I mean, we do hedging and pricing. We do some due diligence, as I said before. We're doing flows. So between that and bulk, it's kind of 50-50, 50 bulk and 50 of the other. We expect, our flow to increase significantly, and we expect to be much more aggressive on the bulk side, because some of the other things that we do and affiliations we have with origination companies, we think all our business is going to improve.
Yeah. Now you mentioned this, that there are investors that have found a number of these blue water clients through internet, and you have names, like, you don't need to confirm or deny, but I'm going to say some of the names that they have found. There are names like Freedom Mortgage, PHH Mortgage, ServiceMac, Texas Capital Bank, big names. So I guess a lot of us are thinking, what is the revenue potential you have with your current clients? So let's say we don't grow from here. Obviously we're going to grow, but if we don't grow from here, what's the revenue potential?
Well, I would say that we're getting new clients every week. Let's put it that way. And we'd be very privileged if they, names that you use, if they were our clients. And obviously I can't tell you if they are or they're not, but certainly those are cream of the crop, first class, well run, highly regarded institutions. And so, if they became or were our clients or our clients, we feel very privileged to have that. And certainly no question that those clients that you mentioned are continuing to grow as the market improves. And so with all our clients, we feel that they are the same. They're going to grow, they're going to improve. But most importantly, people are seeking us out because they want what they don't have, and we're the only ones that offer it. So, really, we got a really, extremely bright bunch of guys at Blue Water. we've been through hell the last year. It has had such a impact on Voxtur, on our overall performance, because we went all in. And the timing, you never ever pick the timing, right? You always hope that the day after you buy it, that they're going to be better the day after than the day before. But there's so many forces of nature out there that can impact any business. And, you know, the interest rate accumulation, along with some other things, was impactful to us. But I'm going to tell you today, it will be the best deal we ever did. I have so much belief in Qureshi and team and the growth and where they're going to take this company, how much influence they're going to have as far as further work for our other business units. It's a really, really good business that is going to be so impactful for the future. You know, we went through hell and back, you know, through a few punches along the way, I'm sure, because, you know, not always is perfect inside a family because you got a lot of stress. But we came out the other side with a lot of respect for Al and his team and where he's going to take this company. And so we are really, really happy. And well, I've read all kinds of press about, oh, are you going to sue them? Do you want to take the business back? There's not a chance. They are going to have such an indelible footprint on us going forward, and we're thrilled to have them.
Is it still running with around 30 employees?
No, they're probably about close to, did you say 13 or 30?
30.
30, yes, that's correct. Yeah.
Okay. Yeah,
and I would say
yeah.
half of them are developers.
All right. So the employee count hasn't changed much.
Their business could go to 100 billion, which you can't do in a month, but they could go to 100 billion without having to add one person. It's a total scalable business.
Yeah, that was one of my questions. What do you think is the capability? Like, how much could it handle per month?
As much as it is out there.
As much, okay, yeah. So like 30 billion per month, you know, it could handle that.
Absolutely. I mean, first of all, you're not going to get it all, so we don't expect that to happen. But we can certainly increase it, you know, 10 times what we're doing and handle it. I mean, Al's very adamant on that he has, you know, the capabilities to grow.
It's very impressive that it can scale so much without
yes. It's kind of why we bought it. We love the technology.
Yeah, and that, I don't know how much time you have. I have a few questions I would like to ask still.
Sure, like as much as you need.
All right. So the token deal with the token securities, is that going to be like? Do you think that will be material? And when do you think it would be material?
Yeah, I mean, it has to be. The whole tokenization business historically, there's been a lot of confusion, you know, about, you know, what is tokenization and, you know, what are the assets behind tokenization. Some of them are intangible and you really don't know what the heck you're buying. So in the Middle East, for example, they passed some new laws and basically in layman's terms said that you have to have real assets. You have to have real tangible assets. So one would naturally think, well, what is the best real tangible assets we can get returns on? So there are things where you can buy a token on a real estate project, like you're building a 60 tower office building, or you're, you know, building a commercial shopping center. That's one asset. And so normally you get a pretty good return on that. However, it is one asset. And so if there's any kind of material disaster on that one asset, then, you know, you're at risk. Why we believe that tokenization will work, and we'll do this through a single purpose vehicle, but why it will work is that if you buy MSRs, you're basically diversifying against a whole portfolio of loans. You know, someone could take $10,000 and have that $10,000 basically broken up between a whole portfolio of loans. And so the beauty about MSR is that if it's fully leveraged, you can generate as much as 15 to 18% return on the money. And on top of that, you start getting paid immediately because you're paying out every month the servicing of that loan. That's what a servicing right is, you know. And so, you know, what better opportunity there is to be able to get the kind of returns you want, to be able to mitigate the risk, because you could have thousands of investors basically investing in millions of loans and start getting paid immediately, you know, on that investment. So I think the industry has tightened up. They love tokenization. They love blockchain. We're in the MSR trading business. We have product that they can invest in, and they can generate massive returns, you know, for their investors. We think it's just an absolutely perfect vehicle for us. We are in significant talks with a number of the large tokenization entities, and we believe that in 2024 you're going to see, you know, what we believe to be a significant participation in tokenization companies investing in MSRs through Voxtur.
Mm-hmm. Yeah, obviously, I was like thinking, is it still kind of an early stage situation, or is it gonna start?
It's farther along. It's farther along than you think. I mean, because we're not going through the whole machination ourselves of you know, creating tokens and doing all that. There's lots of entities out there that are already mature and in that space. We just need to be able to bring product to them. So we're just working with a number of fairly large entities right now that we're getting real close to as far as committing to an investment, you know, in MSRs and using tokenizations. Again, to make it clear, we're not the token company. We're not the blockchain company. You know, we're trading in US dollars, and, you know, we're receiving, getting paid in US dollars. And when that product gets transitioned into the tokenization single purpose vehicle, that's what it is. They're handling the tokens. We're providing the investment to them. Nothing changes in our business other than the type of client we sell to.
You know, in our last interview, you mentioned 2 products that you were looking to get out in Q4. This other one you called Equity Protect, and the other one was some kind of three-pronged authenticator or something like that.
Yeah.
So what are those two?
Let me kind of read you. Ryan Marshall is the author, inventor, / you know, developer of Equity Protect. So I asked him to, you know, to kind of give me an overview on Equity Protect, and if I may, I'll just read it to you so that I don't have to butcher up the description. It's a partnership we have with Equity Protect. We're going to handle all of the commercial partners, and on the other side, which Ryan owns, he's going to look after the individuals. So, for example, myself, when I bought my home down here in Florida, I purchased Equity Protect, and so I know that nobody could go in and have access to my title without going through this 3-pronged identifier. And so it's virtually impossible with the protection of Equity Protect for anyone to be able to go in and put a claim stake on your property and walk away with funding on your property that no one knew about. So let me just read what he's given us. Our partnership with Equity Protect is meticulously designed to function as a recapture tool for our clients, mitigate liability for both customers and clients, and ultimately reduce the cost of refinancing. Given the market turbulence experienced in 22 and 23, coupled with unfavorable interest rates, many borrowers have opted for the 3-2-1 buy down programs. These programs entail a gradual reduction in the loan interest rate, with a 3% decrease in the first year, 2% in the second year, and 1% in the third. For example, a mortgage with a 5.34% interest rate in 2022 could be lowered to just 2.34% in the first year loan. Following this buy down period, the lender applies the full interest rate for the remaining mortgage term. So in other words, they're giving them the ability to be flexible instead of locking them in at a 30-year rate at a high. They're trying to be resourceful, and as interest rates change, and they can buy it down. Through our strategic alliance with Equity Protect, we not only shield against deed theft or seller impersonation, but also offer borrowers a reduced settlement. These cost savings are often utilized to further decrease the interest rate, empowering our lending clients in subsequent refinances. Moreover, we are leveraging this partnership to enrich our Voxtur Verify product, which we talked about, which is the digitization of the loan officer, by extending this feature to all prospective homeowners with no mortgage or low loan-to-value ratios. This feature mirrors the success of the home warranty industry that gained prominence in the mid-1980s. It will serve as Voxtur's primary engagement point with these borrowers in all future transactions. By seizing opportunities presented by 3-to-1 buy down, we aspire to lead the market in capturing settlement, title, and valuation business, thereby boosting revenue with improved efficiency and yielding higher profits than our competitors. Voxtur's embrace of this trend and our first mover advantage have proven to be invaluable assets. We successfully deployed our APIs and branded entry points at the end of Q4 2023. We anticipate generating revenue once interest rates become favorable for refinancing, particularly for those holding arms. So that's the Coles notes on Equity Protect. We're continuing to work with large entities where we're trying to convince Fannie and Freddie to basically deploy Equity Protect at the source of all loans and have a drastically reduced rate for them, but protect, their investments. We're working on trying to invoke Equity Protect in all of the insurance agencies. And again, Ryan's side, he's making good market penetration, on the single investors. What we are trying to do through large broker dealers, which comes over onto our side, is to convince people that are involved in getting title, is at invoking Equity Protect for a very affordable price up front, because the last thing you need to do is have a home, have a mortgage, see your house appreciate in value, and find out that someone came in there fraudulently and invoked a home equity line and put some more debt against that property that you had nothing to do with. It's happening. It's prevalent all over North America right now. We see it in Canada all the time, and certainly down here. And if people use this technology that Ryan has invented, we will basically eradicate the fraud in the lending process of homeowners.
Is this yet revenue generating for you?
Well, we're certainly selling it directly to the individual homeowners, but we haven't. We're certainly have deep discussions going on with the larger clients right now. I mean, just think about it. Fannie or Freddie, and I'm just using them as an example. Be able to invoke this product where every loan that was taking place would be a massive coup for us, and we think that that's doable. I'm not saying that they've agreed to it, but based on the price that we could set it at versus the risk associated therewith, and to eliminating the risk of fraud is pretty attractive. And they could pass that on to the homeowner, and literally for as little as $2 a month, right? To be able to not have to worry about because it's backed by insurance too, so not to have to worry about your mortgage being fraudulently maneuvered with. It'd be a massive coup for everybody. It just takes a little bit longer when you're dealing with large entities. They really need to vet the process in a material way, but we're going to get there.
That's potentially big. Is there have you launched the title kits yet?
Yeah, so what we've done is we've started the first portion of the title kit, and we call it pre-docs. So, we're getting certain information to the title providers right now, and we're able to do it substantively cheaper than what they're doing right now. So we're doing that for somewhere around $15. By the end of April, we're hoping that our starter kits will then be fully completed as far as the technology. We ran into a few hiccups at the end of fourth quarter, so we had to do some retooling. So by the end of April, our starter kits will be ready to hit the market. That's just an extension of the pre-docs. For example, people right across the board are paying $130 for starter kits. We'll be able to sell them for $65. So, we've talked to large independent title companies that are doing as much as 15, 20, 25,000 transactions a month. Massive, massive savings for them. Just, we get it basically within a day of them requiring it. So you get technology, you get the data, you get all of the requirements that you need for a starter kit completed and ready to go. So, again, I think that this has the makings of challenging Blue Water to be our best business in the company. And what's even more remarkable, Eunice, is that every time Blue Water gets involved in due diligence, where they're reviewing loans and they need work, if title is required, if flood certificates or tax certificates are required, here we go. We got everything there that we can deliver to them, in one swell package. So huge synergies for us. Execution is always the key, of course, but we got a great lead in Ryan Marshall, like really, and Jim Adams. The whole team is just phenomenal. Brought on a new salesperson, Rob Reich, been around the industry for many, many years, highly respected. We got those guys super excited and just burning oil like crazy, getting these things rolled out. So again, it all gets down to execution, but we think we got the right team to take us to the next level.
Right. Yeah, that's interesting. Yeah, so the title business could be as big as Blue Water. So that's.
I just love it. I just love what they're doing. It's just, and I think about it. We're profitable now. We were burning $300 a month, right? And it was just suffocating. And me from afar, not knowing in depth. I built the largest valuation business in the world while I was at Altus. We built the largest tax business in the world. I wasn't in the residential title business. I'm not an authority on that. And so, we knew we needed to diversify. We felt that it was a good idea. It still was a good idea, although things didn't work out the way we wanted. One idea led to another. And what we got is we never met Ryan Marshall, and we never met Chad Brown, and we never met Jim Adams, never met Rob Reich. And all of these guys are going to lead the company for the future. And so sometimes there's always a little bit of silver lining in a cloud. And so, we went through a dark cloud, when the industry changed and the interest rates went up and defaults, fell off the turnip truck, and government invoked moratoriums, and then they invoked, kind of last chance initiative, so to speak. That was the buzzword they used. We pivoted, and now we're moving to who we are, and that is the technology play. So always lots of patience, and you got to build a strong shield to to fight off the slings and arrows. It happens. One day you're a swan, and next day you turn into a sow's ear, and then hopefully you then turn into a purse again. And you just got to keep persevering and doing the right thing.
Yeah, this has been on the shareholders' mind a bit. So, Jeff Young sold 400K worth of stock in January on the open market. So shareholders interpreted this as there was an opening for insiders to buy and sell on the open market.
Yeah.
And nobody decided to buy. So is this a correct interpretation from the shareholders?
Jeff did sell, but Jeff is not a director of the company, and Jeff is not an insider as far as knowing what the other company is doing. And as you know, if there's any material information that directors or officers have that they know about the company, then they're precluding from any trades. And so when Jeff needed to sell, and we're not talking about massive amounts of money here. You realize you're talking about $40,000, right, in total. But Jeff, by the way, still owns close to 5.5 million shares.
Yeah.
So it's not a bailout by him, but he just happens to have 3 kids in university, and some big expenses to pay, and unfortunately, because we weren't significantly profitable, what normally would have been bonus money, he didn't get bonus money. He had to get some shares, right? And so life has this way of kind of necking you up and down. Jeff is still very bullish on the company, a large shareholder, and sometimes you have to do what you do, but he was not outside the same rules as what the directors and the officers had.
So just because Jeff could sell, that doesn't mean you could buy.
I know I couldn't.
Yeah.
Right.
Okay.
And it's just, in fact, I last year took in 1.25 million shares at $1.04. And for the benefit of doing that, I had to pay close to $800,000 in taxes.
Yeah.
And so what that kind of impact that is.
Yeah.
In addition to that, a loan which was supposed to be in lieu of benefits, bonuses I was supposed to have, instead of me keeping that, I paid it back. So last year I paid almost $1.8 million in cash for the privilege of working here. And I haven't received net of my net pay, haven't received that much money since Voxtur started. So, just for the record, I'm about $600,000 in the hole as far as my net take home versus what I've had to pay out.
Okay. I have these AOL questions, and then I'm gonna let you go. First is, what is AOL ready? Like, what is that? And how much money have you invested in AOL so far?
So AOL Ready was a technology piece where we partnered with a company, I can't say their name, called the Bonds. And so just to it was basically an onboarding process for AOL. Essentially, that's what it was. And how much we've used it, obviously not enough, right? But it was basically a platform that was built. Sorry.
Yeah, so I thought you would. That was an answer to my second question. So how much money have you invested in AOL so far? Do you have that?
It really. I have an idea, but there's some things that we were building that suited a multitude of different businesses that we had. So, certainly more than $1 million.
Yeah.
But, how much more, I'm not prepared to say, but, let's say between one and three in that ballpark. But some of that can be allocated to other business units that we've done the work for. So it really gets down to how much you want to say is AOL. We're very bullish on AOL. AOL is going to take some flight, but we believe that we were fairly aggressively trying to find the best way to roll it out, and we've done that through what we call our Best X platform. So we're kind of excited about it, and don't be surprised that we don't have other entities that we will wholesale with, that they'll be rolling it out as well for us on our behalf. So, you know, it's going to be, it takes a village to raise your children, and it seems to me that it takes a country to roll out AOL. But, you know, we're bullish on it. It is going to work. It is going to benefit people. It's going to be cheaper. It's not, doesn't fit all sizes, but now we know what size it does fit through our BestX platform, and we'll give all of our title people the opportunity, if AOL is the best fit for that specific property, we'll be able to roll that out for them.
Yeah. Well, I have one thing. One shareholder, or actually not a shareholder, but he asked that, can you ask like, could the company press release the cash level before just because?
No, we can't. I mean, that's no one is going to do that. Let's just say we have enough money to keep the company going. We expect the company to be cash flow positive, and so there's that. We have more money coming in from proceeds from the zone sale. Some is coming in as early as this week. We have proceeds from the dispositions that'll happen over the next, few weeks to months, that will probably keep a little bit of proceeds back in case we need it. But if we don't need it, that's great. We're confident we have enough cash flow, and with the profitability of the business going, it's going to continue to build. So, I mean, it's leaps and bounds of where we were. I mean, we were, think about it again, 10 months ago, before I started, we've reduced staff by almost 400. The burn was almost $3+ million a month. We're now cash flow positive for all intents and purposes. We've, cut down expenses tremendously. We're moving more to a fully digitized, company. Massive changes at great expense, but like, what a massive turnaround for a company. This company is going to make a lot of money. We're going to grow extensively. We have things that no one else has. We have RPTA in the tax business. We have digitized loan officer in the title business. No one is like, Al Qureshi and what he does. We have sketching, floor plan layouts, data collection in our valuation side, which we will be augmenting to and supporting AMCs, where most people that are in competition with us are AMCs, or at least in the valuation business in a material way. We are a technology company. We want to sell technology services in real estate. We are diversified. All our businesses are profitable. I've cut expenses down to the bare bone, and we got, only one way to look, and that's up.
All right. That was all my questions. So if you have any,
I gave you an hour and a half. I said an hour. So hopefully everyone got. And, Eunice, I think that we were taken aback with a lot of the commentaries taking place. I don't take offense to it. It's caused us, to have much more caution, in our discussions and that with you. But I think it's extremely important that on a regular basis that we communicate vis-a-vis through this vehicle. I find that your questioning and your level of integrity, we believe in, and so we're quite happy to use your vehicle. If you continue to be a shareholder with Voxtur, use your vehicle to help us get the word out on what we're doing. Again, we apologize profusely. Management is the largest shareholders. We are the ones that have taken the biggest hit. We've had to make tremendous changes, as you all aware, much more detail than I care to describe. It's been a very, very difficult and painful year, but you know what? We've stuck through it. We worked our asses off to get to where we are today, and we'll continue to stay close to you, as close as you need to keep you and all your investors in Finland and abroad, very much informed of what we're doing. So thank you for the opportunity.
Yeah, thank you for the interview. And,
Okay, thank you. Bye.
Subscribe to Almost Mongolian Substack to get company deep dives and other investment-related articles straight to your email. These articles are written by Almost Mongolian himself. Link in the description.